Good morning, Ed Denny here. Let me just straighten things out here. A little housekeeping. Thank you for joining me today. Lots to talk about. Never a dull moment in our business, that's for sure. Always very, very interesting. Today is February 7th. I'm doing this February 7th in the morning. Let's not forget that a week from now is Valentine's Day, so don't forget to get flowers or chocolates or whatever, but don't forget the important day for your significant other. Let's see, significant others. We professionally our days clearly spent with the financial markets, and there's a lot of interesting developments that the year started out with. We had a pretty nasty sell-off in the market at the beginning of the year. I think a lot of it was triggered by uncertainty about what the Fed is going to be doing exactly. We all know that they're headed towards tightening monetary policy, but they seem to be doing it in slow motion. I mean, I wrote up the other day that if I was in charge, I just raised the Fed funds rate by 100 basis points and said, that's it for the next 6 months. See you in 6 months. Let's see how it all pans out, and we'll reassess things. I mean, the 2-year Treasury note is already at 1.3%. So there's already an expectation in the markets of at least 4, if not 5, maybe even 6 rate hikes. My contrary instincts are that it's not going to be 6 or 7. It's going to be something more like 4. I think that's partly because the Fed funds rate has been kept at 0 for so long that it may not take that much of rate hiking to slow inflation down and to slow the economy down, and maybe even along the way cause a financial crisis. Something might break, which typically happens at some point in monetary tightening phases. So that's something to think about, and markets have been thinking about it and have decided that even if the outlook is for continued growth without a financial crisis, without a recession, without a credit crunch, valuation multiples started out the year quite high, particularly in some of the growth areas, and particularly in the mega cap 8 segment of the market. But all in all, I think the perception is that that interest rates are certainly going to go up, and so that's had an impact on valuation multiples. I guess the question for us is the correction in the valuation multiples over? I think it might be. I think we might have seen a capitulation low on Monday, the January 27th, when the market took a real dive. I think it was around 4,229 on the S&P 500. So that was an intraday basis, and maybe that'll be the bottom of the range that we'll trade in through the next several months, where the high will be the high that was made on January 3rd, right at the beginning of the year, on the S&P 500 at something like 4,800. A few days ago, on February 3rd, how time flies, it's already February, I wrote a piece in which I made a list of what could go right. And I thought, just to be balanced, I'd write a piece this week in today's morning piece on what could go wrong. And the items are pretty much the same issues. The only question is, will the issues work out in a bullish fashion, or will they work out in a bearish fashion? In terms of my list, let me just run real quick through the what could go right. COVID seems to be going right. Again, it could go wrong. There could be another strain out there that the vaccines don't deal with. Under the COVID heading, I should add that one of the things that could go wrong is the Chinese zero COVID policy might not work with the Omicron. I think there was an article in Bloomberg or CNBC posted suggesting that we're all have learned that we've got to learn to live with this virus, with vaccines, with therapeutics, and nevertheless, it's just not going to go away, and it's something we have to contend with. And if we get it, hopefully the therapeutics and the medications and so on will make it a fairly minor problem. But the Chinese are imposing, once again, zero tolerance for COVID, and that means that their population is just not going to be immune to the virus. And there's mounting evidence, even John Hopkins, which at the beginning of the crisis was very, I don't know if they were all for lockdowns, but they certainly weren't against lockdowns, but they've come up with a study saying that lockdowns are just bad, they don't really work, and they kill the economy. Well, what a surprise. I was against the lockdowns, and I thought that the economic consequences would be much worse than the health consequences, but who am I? Secondly, supply disruptions have been a real problem. They could go right, they could go wrong. If we get a real problem with COVID in China, and they're not able to send a lot of parts that are necessary to finish off cars and things like that in other parts of the world, and that would mean that the supply disruptions continue. On the other hand, they've been going on for 6, 9, 12 months now, and companies have been scrambling to figure out how to deal with these supply chain disruptions, and they're solving some of the problems. Apparently, there's some evidence that the car automakers are starting to get some of the semiconductors that they need. I pointed out that Japanese auto production in both November and December surged from its low in the summer when they couldn't get the parts, the semiconductors. So apparently they're getting it. And if they're getting it, then I think there's a good chance that the global auto industry is going to be making a comeback in terms of production, which then will be good for sales. The key issue that could go right or wrong is inflation. I really should have put that as number one, but the inflation is really the issue. If we're in a wage price spiral that just continues to spiral, then the Fed is way behind the inflation curve, and can't dismiss Volcker 2.0. In other words, a tightening of policy in an abrupt fashion that causes a financial crisis, a credit crunch, and a recession. I'm not in that camp at this point. I'm concerned about it. I'm in the camp that believes that the supply chain disruptions are an important reason that we've had prices going up. For example, consumer durable prices have really been leading the way here in inflation. And typically consumer durable prices fall. They don't soar the way they've been soaring. And a lot of that is because of supply chain disruptions. And we've had a tremendous amount of demand, a demand shock caused by excessively stimulated fiscal and monetary policies. But on my list here of things that could go right is we don't get any more fiscal stimulus. We don't get overstimulated. And as a result, demand simmers down, and a lot of pent up demand, particularly of goods, durable goods, has been satisfied with the exception of autos. But as the auto production cranks in, we should see both used and new car prices start to settle down. But inflation is the key. And to the extent that the Fed is clearly already behind the curve, and all you have to do is look at the difference between the Fed funds rate at 0 and take your favorite inflation number, and we've got negative Fed funds rate of somewhere like 5 to 7%. So they're clearly behind the curve, but if the curve starts to bend and we see inflation coming down on its own because some of these issues are resolved, that would obviously bring great joy and cheer to the markets, and would mean that, yeah, the Fed's behind the curve, but they can catch up, and they don't have to catch up in an abrupt fashion. If we are, in fact, if the Fed's responding too little, too late, and then realizes that, and inflation is more of a wage price spiral, then that would be just a downright bearish scenario. On my list also is obviously Russia and Ukraine. The tensions there are mounting. I don't know whether he's going to invade Ukraine or not. My hunch is that he will after the Olympics are over. I doubt that the Chinese are going to simultaneously invade Taiwan, but something like that would be a nightmare scenario. Certainly, Russia invading the Ukraine could push up oil prices. Oh, and by the way, there's speaking of the axis of evil, not only do we have to contend with Russia and China, but the Iranians are continuing to move towards getting nuclear weaponry, and the Israelis know that, and there's always a potential for conflict there. So the prospects geopolitically for oil are, the price of oil is not coming down, and it could go still further higher, even though it's already up a lot as a result of any of these kind of crises. The good news, I think, is there's still a tremendous amount of cash in the system. I've estimated $3 trillion in excess M2. We can see that in cash positions of the S&P 500, over $2 trillion. Cash positions of the overall corporate sector is up like something like $3 to $4 trillion. And what's this cash being used for? Well, a lot of the cash was raised. Do you know that over the past 24 months, non-financial corporations have raised $2.5 trillion in the bond market? Now, some of that was used to refinance outstanding debt or maturing debt at historically low interest rates. Some of it was used for buybacks and will continue to be used for buybacks. Some of it is being used for M&A. And as I wrote recently, the January pace of M&A, it was mostly all in tech, and it was $156 billion. And it was twice as much as we did during January of last year. So maybe the Fed put is kaput, as I've said before, but the CFO put is still very much in play, so that anytime you get a significant sell-off in companies that might be targeted by other companies, that could bring in a lot of cash to acquire those candidates. I mentioned buybacks. I mentioned that the fiscal situation might stabilize to the extent that we just don't continue to have these programs after programs of extreme stimulus. So the other issue is the PE. Has the PE come down enough? It's still pretty elevated. I noticed that for the S&P 500, it dropped to below 20 during the sell-off, but now we're back around 20. So it's not exactly dirt cheap. And the mega caps have been all over the place. We've seen some really disappoint and get really whacked, and others really delivered and have benefited. So all in all, the earnings season doesn't seem to have had a meaningful or a tremendous impact in either boosting PEs or really depressing PEs. But again, I think with all the cash that's still out there, that would argue for valuation multiples staying high. But of course, with inflation being a problem and the Fed being on a tightening curve, that would be an issue. What else do I wanted to mention here on my list? I think we covered it all in terms of inflation being the big issue, oil price within that. Oil prices are still going up, so that's not a happy situation. And the wage price spiral continues to show signs of spiraling. But we do have some signs that supply chain disruptions are easing off. And so the jury is out. Let me share my screen with you so we can flip through some of the charts in a few minutes, and then we'll open it up for some discussion. All right, so here we are, February 7th. This is the chart collection for this morning. And of course, we start out talking about the employment report that came out on Friday. People were surprised by the strength of the payrolls, up over 400,000. The ADP was down over 300,000. Debbie and I are going to side with the BLS data because it just makes more sense. I mean, yeah, of course, people got sick with Omicron and called in sick, but they remained on payrolls. And meanwhile, we know that employers have been desperate to hire people. So, I mean, they could have been hiring a lot of people who called in sick before their job even started and said, look, I'm gonna need a week or two just to recuperate. But here you can see that obviously work illnesses, calling in sick was a big part of the January story, but that did not apparently affect the Bureau of Labor Statistics conclusion that a lot of people found jobs. And by the way, they revised up their numbers for November and December. I'm thinking that the American Rescue Plan, with its child credit and with the $300 per week in benefits, might really have provided disincentives for people to go to work. And now that both of those supports are gone, sure enough, we saw like a 1.4 million increase in the labor force and 1.3 million increase in household employment. and 1 million increase in full-time jobs. Full-time jobs have been expanding very rapidly, which is really great news. And I think a lot of employers have concluded that, if you got somebody that's part-time, hug them and give them benefits and make them work full-time, especially since it's hard to get two workers. Why not get one worker working full-time? So the impact on the employment statistics, I think, was in the average work week that came down. And yet, despite all that, our handy-dandy employment earned income proxy, I should say, continued to make a new high here because payroll employment was up and wages were up a lot. Adjusted for inflation, inflation is clearly taking some purchasing power out of consumers' pockets. But here you can see the revisions. The 12-month revisions are over a million. And again, would the Fed maybe have realized that they had to start tightening sooner if it hadn't been for the support programs that kept people from going to work? And meanwhile, the revisions show that the labor market was stronger than the Fed had anticipated. Should they have anticipated it? Well, this chart shows that during recessions and after recessions, revisions tend to be negative. But once you get into the expansions, revisions tend to be positive. And this has been kind of a supercharged, compressed business cycle. And here we go. We had that revisions downward, now revisions upward. I think it's pretty forecastable that the revisions are going to be to the upside, and the Fed was reacting to numbers that seem to be disappointing. Here's that series on household employment. I mean, talk about a V-shaped recovery. It's really been quite extraordinary, and we're almost back to where we were before. And I think given the tightness in the labor market, we're going to see more people who might have only been given an opportunity to work part-time, now giving and taking an opportunity to work full-time. Productivity came out, and as you know, that's a big part of our roaring 2020s. It doesn't feel like the roaring 2020s right now because of inflation and some other issues. But underneath it all, I still think that we're seeing productivity making a comeback. And anecdotally, we know that companies are spending a lot on technology and capital goods to increase productivity because they have to, because there's a labor shortage. And so the quarter-to-quarter numbers are very volatile. Even the year-over-year can be volatile, though it was up 2%. As I've argued with not argued with you, but as I've shown you before, the 20% change in productivity, non-farm productivity, the red line, is probably a smoother way to see the underlying cycle in productivity. And it bottomed here, and now we're up to 1.9%, which is pretty good. So we're still on an upward course. We think that the pandemic accelerated the pace at which productivity should be increasing. It is highly correlated with inflation-adjusted real hourly compensation, which makes sense. When productivity increases, it trickles down to real wages, real compensation. And so that's actually doing quite well. This was that underlying story behind why productivity is likely to improve. And that's because the civilian non-institutional working age population and labor force, which obviously are related, has slowed pretty dramatically here. And we used to have 2-3% growth back in the 70s when I entered the labor market. Then it kind of settled down to about 1.5 to 2%. But of late, it's been more like 0 to 1%. And I think the outlook is 0 to 1%, which means labor will remain chronically in short supply. And the result will be companies spending on technology and capital goods to increase productivity. With regards to some of the points I made of what could go right, what could go wrong, a lot of them have to do with the Fed, and a lot of what the Fed's going to do has to do with inflation. So you've got to pick your sides on inflation, though we can be open-minded. We can pick a side and realize we're wrong, hopefully in time, to avoid losing much money in the markets and making some money on the insight. But at this point, as I said, there's the great inflation 2.0 scenario, or there's a scenario where the inflation curve starts to bend, because a good significant part of that inflation was related to pandemic issues. So we'll see, we'll be watching that, how that plays out. But the Fed this is the Fed cycle. And this chart you might want to look at when you have some leisure time, just to corroborate that when the Fed tightens, at some point in the past, we seem to have gotten these financial crises, which then cause credit crunches, and then recessions and bear markets, of course. So the 2-year note keeps showing you that it's already discounted more than a 1% Fed funds rate. So why don't we just do it already? Meanwhile, the Fed is, I don't know what it's doing, taking a walk in the park. I've yet to see any real slowdown in their balance sheet. So they're still accumulating securities. I would have thought that this would have started to flatten out, but it hasn't been. But when they come at us in March, that meeting will be decisive, and they will announce that they've stopped buying securities, and that they are about to raise the Fed funds rate. And the debate is 25 or 50 basis points. And the answer will probably depend on what the next couple of inflation numbers look like. So here's that excess liquidity in M2, about $3 trillion. Here's that liquidity in the corporate sector, $2.5 trillion of monies that have just been raised. The cash flow, of course, is extremely strong. This is another measure of liquid assets. The Federal Reserve has a bizarre number of 6.9 trillion that includes equities and mutual fund shares held by non-financial corporations, and that's included now in liquid assets. It's something they did a few years ago. I prefer to look at the red line, but even that's pretty impressive at 3.7 trillion. So there's a lot of cash sitting on the balance sheet, a lot of cash that's been raised to refinance debt, and that's sitting in cash that can be used to finance buybacks, M&A, et cetera. Here's the risk with the price of oil. You look at the history, and while credit crunches tend to cause recessions, there is a unhappy correlation between spikes in oil prices and recession. So that's something we certainly want to be cognizant about. And could this thing spike over 100? Well, we're almost there. Could it spike to 150? Tell me what's going to happen in the Ukraine. Tell me what's going to happen with Israel and the Iranians. But there's clearly geopolitical risk. Meanwhile, as you might have seen in the Wall Street Journal, it's hard to get the frackers to pump more because their wells are running dry, I guess. They certainly have an incentive to pump out more if they had it, but it's not happening. So the journal concluded that the era of having the frackers come in and produce enough to keep the price of oil down is over. And I don't know why they use the word era, because it was basically a few years back here. So it wasn't much of an era. And then, of course, the issue again with inflation, are we in a wage price spiral? It kind of feels like the early phases of that, but maybe it's not that early. I mean, if you look at average hourly earnings, we're already seeing the kind of numbers we saw at the bottom, at the lower end of the inflation that we had in the 1970s. So that covers my spiel. I spent a little bit too much time doing that. Let me now go to your questions, and I appreciate you joining me and asking the questions. Are you more bullish on China, where the monetary policy is entering easing phase, versus tightening in USA? Don't ask me about China. Philosophically, morally, I just can't recommend investing in China. The Chinese market did terribly last year. Maybe they're going to have a good year this year. But I'm in the human rights camp when it comes to investing in China. I am not for investing in China. So that's all I can really say about that. But not to say that I'm not watching China. China is extremely important, how they deal with the Omicron and whether zero COVID works, the tensions over with China and Taiwan. And then this alliance between, well, it's really an alliance between the three components of the axis of evil, right? The Russians, the Iranians, and the Chinese are finding more and more in common. And what they have in common is they don't like the American way. They don't like the Anglo-Saxon philosophy or ideology or world order. They have their own view of what the world order should look like. And it's fundamentally antagonistic to the Anglo-Saxon world order. So this is these are tensions that are going to continue, and in many ways, it's just a move towards another Cold War, if you will, and hopefully it stays cold, obviously. Okay, Doug, when do you think inflation year over year will peak? The answer is, I think I would like to start to see some signs of that in March, April, May. I mean, the increases in car prices, they're not sustainable in my mind. And some of the supply disruptions that have held things back. A big part of it is demand. Demand should be slowing down. We had a demand shock that caused a supply shock that exacerbated this spike in inflation. Doug has some more. And if that comes to pass, what is the upside for Fed rates and by derivation, the S&P? Okay, it's I mean, we could spend hours on this one, but basically, I'm aiming for 2% on the Fed funds rate, 2.5%, maybe 3% on the 10-year bond yield as being the peak, and they can happen sometime this year. Jay, productivity seems increasing, thus thwarting the higher wages. How would the trend likely be in the coming months? Well, that's kind of that's right. I mean, that's kind of the way I'm putting it together. It's the Phillips curve was always about a kind of a relationship of wages to prices, and never seemed to account for productivity, which makes no sense. And so I like to watch wages, prices, productivity, and profit margins. The profit margins, the weekly data we look at, the proxy for profit margins have held up remarkably well at record highs, and that's through the end of January. So there's not much sign in our weekly indicators that profit margins are getting squeezed. I know anecdotally we've heard from companies during the earnings season that their costs are going up, but it's not like they're doing nothing about it. Some of them are, in fact, pushing, raising wages, which means their costs are going up because they have to. Some of them are passing that through in higher prices. Amazon increased its Prime fee. But I think there's the fact that profit margins are holding up so well in an environment where costs and supply disruptions and labor shortages have been so widespread, suggests that productivity is making a comeback and was accelerated by the pandemic. Let's see, so that was Jay. See, Nick, are there good historical precedents for the inflation curve bending back by itself, supply side constraints that work themselves out? I don't think so. That's a very good question. Let me just, I want to scroll to see how many more questions we have. Okay, I'll take a couple more because we do like to keep this to half an hour. But no, I can't think of one offhand, but I'll think about it some more, and you'll see it in tomorrow's morning briefing if I come up with something. But it is an unusual situation. I mean, the pandemic is unusual. The excess monetary and fiscal stimulus is unusual. The demand shock that overwhelmed the supply system and caused a supply shock is quite unusual. Running out of semiconductors is unusual. Then again, I guess I could have sat in the 1970s as I did and argue that a lot of what happened then was unusual, kind of bad luck. So a run of bad luck in a lot of areas can add up to a great inflation the way it did in the 1970s. But in the 1970s, productivity collapsed down to zero. I think it's going the other way here. I think the technologies that are available are much more powerful in productivity. I think supply chains are coming back home, whereas in the 70s, we saw a lot of deindustrialization going into the 1980s. Okay, David said that he agrees with me 100% on China. What would make you upgrade your S&P forecast? Okay, so as you may have read or heard me say that the past couple of weeks, Joe and I announced that we were lowering our expectations for the S&P 500 from 5,200 by year end, which would have been about an 8% increase. I forget 80%. The double-digit increases in the S&P 500 are kaput. They're not going to happen anytime soon. Unless we take a big dive and then have another big increase. But we were looking for 5,200. Now we're tone that down to 4,800 by the end of the year. So the market basically would be flat for the year in that kind of scenario. We like energy, we like financials, and we'd be buyers of any beaten down technology stocks here because we think their fundamentals are great and will continue to be great. So we're pushing the 5,200 into next year, second half of next year is the way we're looking at it. It's hard, I mean, I have to admit to you, 5,200 was a push because I had to assume, as you know, and I confessed that I was assuming that the forward PE would stay around 20 to 22 for the S&P 500. I did get a lot of pushback on that, and maybe there's sometimes when somebody's pushing you should pay more attention. And we did kind of in this January sell-off see a PE sell-off, which is the way corrections occur. It's PE, not E, that takes a dive in corrections. And yet the PE still, last I looked, was around 20 as of Friday. So maybe there's some more correcting to be done on the downside. But overall, I think the S&P 500 X the mega cap is actually not too expensive. It's running around 17.5 to 18.5. And the mid caps are just dirt cheap. I mean, 14, 15, they're remarkably cheap. Okay, let's take one or two more and then we'll call it a day. Do you have an opinion on the usefulness of the Fed model or your Yardeni model to help forecast appropriate market valuation in this environment? Yeah, I concocted the what I call the Fed model back in the late 1990s, and I discovered it just as it stopped working. I mean, it really worked right through 1999, 2000, and then it just didn't work anymore. It suggested that stocks were cheap relative to bonds, and it took a while for the market to finally get going. But it wasn't valuation that drove the market to its highs in the bull market of 2008. It was actually earnings that to a large extent drove it. We didn't get the kind of Buffett ratio of 2+ in 2007, 2008, the way we did in 1999, and the way we're doing now. We're well exceeding to running more like 2.5, 2.8. So yeah, that model is I'm watching it, but I'm not using it much at all. One last one. Thank you for taking. Okay, do you think the nearshoring of supply chains to outside of China will drive the cyclical inflation we are currently experiencing into a secular inflationary regime? A good question. Jackie and I did a piece on Thursday on onshoring and came to the conclusion that there's more and more evidence that it's happening. It's happening in semiconductors. It's happening in lots of areas of manufacturing. And that could be more expensive to bring back production to the US. But on the other hand, the technologies that are available to make onshoring very efficient and productive, state of the art, I think are significant. So I'm not sure that it necessarily has to be a source of inflation. It could actually be a source of deflation to the extent that it's part of the whole productivity story. And that's kind of the way I'm thinking about it. In any event, it just would have happened anyways, I think, because cheap labor is just not something that's widely available on a worldwide basis, certainly not in China anymore. Even they're bringing in robots. And so I think the global demography was moving towards onshoring in any event. Well, look, you're all very nice to join me today, and thanks for tuning in, and let's do this again next week. All the best.